Morning, folks, and today's story is called Webvan, my favourite business failure. And to clarify the title, I don't love the Webvan story because it failed. I don't like to see any company fail. But because the story behind Webvan is the story of the internet boom, those 5 years from 1995 to 2000, when me and my friends, we were young, eager, hungry, and the internet opened up so many opportunities for us. And the Webvan story, its ambition, its scale, its purpose to replace grocery shopping. I mean, yeah, it's pretty mundane, but it's also hugely impactful. And Webvan's demise was so fast as well. It just makes for a fascinating story, set in a time that I have nothing but very fond memories of. So enjoy. It's a cracking episode. And just a quick reminder, while these shorter weekly episodes released every Wednesday are free for everyone, for just $1.99 a month you get access to our co-hosted hour-long episodes released on the first of every month, where Keith and I do an even deeper dive into an incredible business story. Some of these hour-long episodes are still free in our back catalogue, so you can get a taste of what to expect. Now, as well as getting access to these monthly co-hosted hour-long episodes, behind the paywall are additional bonus episodes. And over the coming months, we'll be adding more bonus episodes for subscribers regularly. Some of these are two-parters, some are three-parters, and some are standalone episodes. Also, as a subscriber, you can listen to these weekly episodes ad-free, so you won't have to listen to me telling you about our great subscription offer. And it is a great offer. For just $1.99 a month, you can subscribe via Apple subscriptions, Spotify subscriptions, or on Patreon using the link below, or go to patreon.com/Great Business Stories. The Webvan story begins in 1971 when Lewis Border co-founded Borders Books with his brother Tom. But whereas Tom cared about literature, Lewis was all about the logistics, because for Lewis, the thousands of titles on their shelves, they were an inventory nightmare, a headache. So he built a system called BIS, or Book Inventory Systems. And this was a revelation, because it didn't just restock bestsellers. It tracked patterns, it forecasted demand, and it accounted for over 50 micro seasons of book sales across genres and regions. And so using that system, the two brothers, they expanded from one shop in Ann Arbor, Michigan, into a chain of 21 superstores. And when Kmart bought the company in 1992 for $200 million, it confirmed what Lewis had always believed. In other words, the system is everything. So jump forward, we're in the mid-90s, he was living in Silicon Valley, and Lewis is looking for a problem to solve. And like any great light bulb moment, it happened when he was doing something very mundane. He ordered a packet of Japanese spices from a mail order catalogue, and the inconvenience of doing this, having to order food from a catalogue and wait days, if not weeks, for it to arrive, like, it struck him as being absurd. And remember, this was 1996. Netscape IPO'd just the previous year, launching what became the dot-com boom. Amazon had just launched in 1995, just as an online bookseller. There were loads of startups emerging, each aiming to disrupt a particular business sector. And Lewis Border, he was aiming for the biggest and most ambitious disruption of all. He was going to take on the grocery business. Not to provide a service to help existing grocery businesses with online deliveries, but to start his own online grocery business with the goal of delivering groceries to the customer's doorstep within a 30-minute window of their choosing. He also realised that groceries, with so many perishable products, it was the hardest category to get right. So if he could solve the logistics of perishables, he could solve everything else. In other words, he could deliver everything else. And so in December 1996, he incorporated the company. It was initially called Intelligent Systems for Retail. That was the mission, to build a seamless end-to-end delivery system. Now, the name didn't change to Webvan until 1999, but I'm just going to call it Webvan from here on out. So Lewis Border believed that eliminating retail store costs would give him the edge. He believed that retail inefficiency could be engineered away. So if you eliminated the overhead of maintaining storefronts and all the staff that came with these retail stores and replaced them with these machine optimized warehouses, you wouldn't just match traditional grocers, you would crush them. And in the fall of 1997, he took the pitch to Silicon Valley. And of course, the timing, it couldn't have been better. Venture capital was flooding in. Big ideas were everything. And what's crucial here is Lewis Border wasn't just some kid with an idea sketched on a napkin, because that's what it was like back then. There was almost a hysteria, a mania around the internet. It's hard to describe, but I had first-hand knowledge. Myself and a few friends, we weren't in Silicon Valley, we were in Dublin. And around this time, we pitched to an investor for an online stock photography business. We had no experience in that business at all. I mean, one of my friends was a young photographer. That was about it. And we literally sketched the idea on a blank piece of paper in front of the investor and got seed funding. It was a crazy but brilliant time. And Lewis Border, though, he was in a different league to us and to most of the other startups at that time, because he'd already built a massive business on the back of mastering logistics. So he was like a prime investment. And VC firms, Benchmark Capital and Sequoia Capital, they jumped in, and along with Borders themselves, they invested 10.5 million into the company. By early 1998, SoftBank, which was then making a real name for itself for massive investments into online startups, they led a new funding round of just over 35 million. And the premise was pretty simple, and it was the mantra for all .coms at that time, which was GBF, get big fast. That was the strategy. Scale rapidly, grab territory, lock down market share. It was a gold rush, and a slow rollout just wouldn't cut it back then. You see, everyone back then was thinking that all of these internet startups were going to totally disrupt the different sectors that they were bringing online. And so there were so many businesses that raised huge amounts of money on this promise of total disruption. You had eToys, Pets.com, Boo.com, and again, all with the same mantra: get big fast. And as mentioned, Webvan, they'd be the ultimate disruptor. And as a result, it was the startup getting most attention, because even though groceries are kind of boring, the US grocery business was a 400 billion market at that time, and the impact a company like Webvan could have on everybody's lives was huge. Like, the feeling was that within a few years, a lot of us would never need to go to the grocery store again, because Webvan were promising to deliver everything that you could buy in a superstore. So the hype, the opportunity around what Border was proposing was so much bigger than any other internet company at that time. Now, the company's 1999 S1 filings, which is the registration statement that companies submit to the SEC, it laid it all out in black and white. Like, orders would arrive at your door within 30-minute windows. You'd choose from thousands of products, everything from fresh basil and frozen scallops to dog food. Same-day delivery, no extra charge if your order is over $50. And to facilitate the logistics behind the plan, they needed to build massive robotic warehouses, each 330,000 square feet, custom engineered, each one costing between 25 and 35 million to build, packed with automated carousels, 5 miles of conveyor belts, chill zones, freezer corridors. Each warehouse would be able to handle the volume of 18 grocery stores using just a fraction of the labour. So it all sounded fantastic. And so in July 1999, Webvan signed an agreement with Bechtel, the industrial giant that builds airports, pipelines. They built the Hoover Dam. They built entire cities. So Bechtel would build up to 26 of these mega warehouses across the US over the next 3 years for a total contract value of $1 billion. And as we mentioned, the logic was speed. Get big fast, first mover advantage, scale fast enough and wide enough to lock out rivals before they could get off the ground. Because by this stage, there were other startups moving into the grocery sector, like Peabody. But of course, one of the problems with this strategy is that it doesn't leave any room for flexibility, no room to learn from the customer. And this is one of the key failings with Webvan. Louis Border's expertise was in logistics, and their focus leading up to its launch, it was all on logistics. It had recruited hundreds of software developers, of logistics experts, but notably, almost none of Webvan's early leadership team. Like they'd no prior experience in the grocery industry. And this outsider perspective, it was double-edged. I mean, on the one hand, yes, they weren't saddled with grocery industry's conventional wisdom. But on the other hand, like they've massively underestimated the sector's complexities. I mean, from razor-thin margins to the challenge of handling fresh produce. And crucially, and this is important, they never really put much thought into what is one of the key elements of any retail organisation, understanding customer behaviour. And this was a huge shortcoming. So a lot was happening for Webvan in 1999. It raised 72.8 million in January, another 275 million a few months later, valuing the company at 3.6 billion. And then on June 2nd, 1999, they went live. The first Webvan deliveries rolled out across the San Francisco Bay Area, and there was, of course, considerable buzz in Silicon Valley. Many were eager to try it. Early customers logging onto Webvan's website, they found a very polished online storefront with over 15,000 items listed: fresh fruits and vegetables, meats, dairy, canned goods, frozen foods, toiletries, and even some general merchandise like ink cartridges. And Webvan drivers, they dressed in these beautiful green and purple uniforms, and they would not only bring your groceries to the house, but they'd even unpack the bags if you wanted them to. But there were some major underlying issues with the business model. First of all, they were marketing it to the wrong target market. They were providing high quality groceries, the kind you'd expect, say, in Ireland and the UK from Marks and Spencer's, or in the US from Whole Foods. But they were marketing themselves like your typical big box supermarket. And that type of customer, the big box customer, is more price sensitive. So they should have really zeroed in on the Whole Food, Marks and Spencer's market, a smaller market, yes, but one more suited to their products. And also it would allow them to charge more because that type of market isn't as price sensitive. Then they could have scaled from there. But they wanted to be everything to everyone, and that's never a good marketing strategy. But at the same time, they were selling themselves to Wall Street as this huge disruptor. So going after a small market just wouldn't have cut it. So a lot of confusion about what kind of retailer they wanted to be, and a lack of understanding in relation to their market and their target customer. Also, there were big usability issues with their website that caused confusion. I love this because it really makes you realise how the change from grocery store to online grocery shopping is so much different. So they tried to rethink the whole way that grocery foods were presented. So on the web, for example, you don't need a frozen food aisle as such. You need it physically, you don't need it online. So whereas shoppers would expect to go to the frozen aisle to find, say, ice cream, instead on the website you'd find ice cream under desserts. And there wasn't a chilled aisle on the site. So milk instead could be found in several different places on the website. For example, they might have a breakfast section where you can get fruit, cereal and milk. And while in one way this was very, very cool, to many shoppers it was just confusing. And of course, Webvan was also missing out on shoppers' impulse purchases. See, when people are in a physical store and are browsing the aisles and waiting at the checkout, they tend to buy stuff that they don't necessarily need. And these impulse purchases tend to be massively profitable to supermarkets. And you just don't get that on a website. So they were losing out on an awful lot of revenue that is essential to a supermarket's profitability. Also, you have to remember, this was over 25 years ago. Internet speeds weren't even like close to what they are now. So it was a very slow and sometimes frustrating process to do your online shopping. And just a quick reminder, while these shorter weekly episodes released every Wednesday are free for everyone, for just $1.99 a month, you get access to our co-hosted hour-long episodes released on the first of every month, where Keith and I do an even deeper dive into an incredible business story. Some of these hour-long episodes are still free in our back catalogue, so you can get a taste of what to expect. Now, as well as getting access to these monthly, co-hosted hour-long episodes, behind the paywall are additional bonus episodes. And over the coming months, we'll be adding more bonus episodes for subscribers regularly. Some of these are 2-parters, some are 3-parters, and some are standalone episodes. Also, as a subscriber, you can listen to these weekly episodes ad-free, so you won't have to listen to me telling you about our great subscription offer. And it is a great offer. For just $1.99 a month, you can subscribe via Apple subscriptions, Spotify subscriptions, or on Patreon using the link below, or go to patreon.com/Great Business Stories. Now, at the same time, there was big change inside in Webvan's leadership, because the investors, they trusted Borders' logistics expertise, but they didn't believe that he was the type of CEO that would bring them to the next level, because an IPO was in the works, and the belief was that they needed a more seasoned executive to be in charge. Now, this was typical for back then. I mentioned it in other episodes that during the dot-com boom, VCs would often replace the founder with a safe pair of hands, or what was referred to back then as a grey hair. Someone who would calm Wall Street's nerves and add a executive polish. Now, you know my views on this. I think it's always a terrible idea. I believe that the founder has the drive and the vision to take a company forward. I do think there's a role for a seasoned executive in guiding the founder, but the founder should be in the driving seat. My thinking isn't all that revolutionary. I mean, nowadays, for the most part, founders stay in charge. But that's not how it was done during the dot-com boom. And in fairness to Webvan and their investors, they managed to hire one of the most senior and respected grey hairs from corporate America when they recruited George Shaheen as Webvan CEO in September 1999. Because Shaheen, he was boardroom royalty. He was CEO of Anderson Consulting, now known as Accenture. And during his time as the CEO there, he increased revenue from 1 billion to 8 billion. So huge success. And when Webvan approached him, he was 55 years old. He was earning $45 million a year. So he left one of the world's most stable, respected firms to join this startup that hadn't yet turned a profit, was burning through cash by the truckload. So the announcement, it rocked the business world. Even Shaheen's colleagues were caught off guard. One analyst called it a thunderbolt. Now, of course, it helped that he was getting a 13.5 million signing bonus, stock options that could be worth around 250 million if everything worked out. But even more intriguingly, I love this little detail. As part of his agreement, if he ever left the company voluntarily or not, Webvan would pay him $375,000 a year for life, guaranteed. So, yeah, money was a factor, without doubt. But I'm going to give Shaheen a break here because, as mentioned, I know exactly what the atmosphere was like back then. If you were interested in business back then, it just seemed like a magical time. And I know, I'm probably looking at it through rose-tinted glasses, but that was my experience of that time. There was this huge surge of optimism around the internet. There was this real belief that it was going to change everything. And the fact that corporate executives from the very highest ranks like Shaheen were jumping ship to get involved in internet startups, it only confirmed our own beliefs that this was real. And, Shaheen saw this as a great opportunity. And I don't blame him. When you have someone with Lewis Borders' expertise, funding from some of the best VCs at a time when everyone thinks that the internet is going to revolutionize retail, which in fairness it has done eventually, and one of the most ambitious internet ventures at that time, I think, fair fucks to Shaheen. He left his 30-year career to join something new, ambitious, fun, and it didn't work out for most of us, but it was thrilling to be involved. Now, for Webvan, Shaheen's arrival, it was a coup. He gave the company the credibility it needed to go public, and he had this calm, corporate demeanour that venture capitalists on Wall Street wanted when, pitching to institutional investors. It was also put out there, this is funny, that he was the son of a grocer, a detail, that looked good in press releases, but look, in reality, his actual business experience had nothing to do with groceries or logistics. So the company had a logistics visionary who didn't understand customer behaviour and a CEO who didn't understand operations. But that's all with hindsight, because at the time it looked like the perfect pairing, a logistics genius and one of the most respected CEOs. Now, Lewis Border, for his part, he welcomed Shaheen on board and he shifted to the role of Chief Product Strategist and remained Chairman of the Board, but he handed day-to-day executive control to Shaheen. So, with Shaheen on board, they were heading for an IPO. And as IPO day approached, news of potential losses started to get into the public domain. During what was supposed to be a legally silent quiet period, a banker from Goldman Sachs, Webvan's lead underwriter, on a private call with institutional clients, he leaked unaudited projections for Webvan's next 2 years, and they forecast a $154 million loss in 2000 and over $300 million loss in 2001. The company's SEC filings, they also revealed that up to that point, Webvan had accumulated only about $4.2 million in revenue while racking up over $50 million in losses. And its Bay Area facility, while it was getting really good reviews from customers initially, it was running at only 20% capacity. But you see, in the days of the dot-com boom, losses were rarely seen as a negative. All people could see was the potential. And there was this understanding that huge investment would be required to realise that potential. On November 5th, 1999, the IPO went ahead. Priced at $15 a share, it raised $375 million. The stock initially surged right out of the gate. It reached a high of $34, later settled down to $26. And by the end of trading, Webvan was valued at $8.5 billion. So on paper, it was now worth more than Kroger, worth more than American Airlines. And the year 2000 opened up with momentum, high expectations. Webvan was expanding. It was building the warehouses it had planned. In February of that year, Shaheen spoke to the press with absolute conviction. He said the model was working, and he pointed to metrics like rising average order size up from $72 to $80. There was great satisfaction rate from customers. Like, it all sounded good, except there was one very negative figure that jumped out. Customer acquisition cost was $166 per customer. And that was just the marketing cost. That didn't include the cost of stocking, processing, delivering the order, all these other huge costs that it was dealing with. And when you take into account that the razor-thin margins in grocery are around 1 to 3%, every customer that Webvan got on board would need to be coming back so many times for them to break even on each customer. And this wasn't happening, because even though Webvan was able to show good uptake in that shoppers were interested in using the service, for example, in San Francisco, almost 6.5% of households used Webvan in the first year and a half. Crucially, more than half of them never placed a second order. So they weren't getting that repeat business, which was crucial. Then came March 10th, 2000. That day, the Nasdaq hit its peak, and then it started falling, and it didn't stop. By the time the crash bottomed out, the index had lost 78% of its value. The dot-com bubble had burst. I mean, for Webvan, it was existential. Their strategy relied on capital, lots of it, like to build the warehouses, to hire the driver, to lose millions in every city while it was scaling up. But within weeks, the world had shifted. Investors were pulling back. They wanted profits, returns. And in fairness, it wasn't just existential for Webvan. Almost overnight, investment, which was the lifeblood of the boom, it was just cut off. Like, our investors in Dublin were out of business within a few months, and so were we and thousands of other startups. But Webvan had money, so they kept moving like nothing had changed. Instead, they were doubling down. They were pushing into new markets. They had already signed leases for warehouses in New York, Dallas, Denver. By this stage, they were servicing 9 cities. Then came June 26th. Webvan announced it was acquiring homegrocer.com. The price was $1.2 billion in stock. Now, at this stage, Webvan shares had collapsed. They were about $7, down from the IPO high of $34. Homegrocer, it was the closest thing Webvan had to a real true competitor. And while Homegrocer's IPO just a few months earlier had raised $288 million, they were losing money almost as fast as Webvan. For example, the previous quarter, home grocers' losses were $137 million. So Webvan wasn't buying a strong asset. It was buying another startup that was also in serious trouble. So that was a big, big mistake. But Shaheen spun it hard, presenting the deal as a power move. He predicted 1.2 billion in combined revenues with 200 million in savings for 2001. But none of it held up under scrutiny. Both brands continue to operate in different markets, creating confusion in messaging and in operations. The Webvan technology, it didn't work as well as they had expected. It didn't integrate well with Home Grocer. In essence, the acquisition only increased Webvan's problems. And instead of pulling back and fixing its model in one market, it expanded its footprint, its cost base, and its distractions. They were on a downward spiral by this stage. Overall losses for the year were 525 million. On January 25th, 2001, the company cancelled its planned launches in New Jersey, Baltimore, Washington, D.C. Other cuts followed. Marketing budgets disappeared. A delivery fee was added, $4.95 for smaller orders, and the product range shrank. So, of course, customers left. In February 2001, Lewis Border resigned as the company just continued to burn through its cash reserves. In April, they reported a net loss of $217 million for that quarter alone, and an accumulated deficit of $830 million. And the report also included the following sentence from their auditors that confirmed really everything when they wrote that there was substantial doubt about Webvan's ability to continue as a going concern. So the writing was on the wall, and a few days later, Shaheen resigned. By June, its shares had plunged 99%, trading at about 8 cents. So on Monday, July 9, 2001, after burning through about $800 million, the end became official. Webvan ceased operations and it filed for Chapter 11 bankruptcy. All employees were let go without any severance package, but curiously, an individual who asked to remain anonymous provided $1.5 million to give each of the 1,700 hourly employees a $900 gift. Who was that person? Why did they do it? I couldn't get a verified answer, but in one article I found it speculated that the anonymous donor was Lewis Border. Of course, the analysis, the autopsy, whatever you want to call it, it came in quickly. Investors, founders, analysts, they all weighed in. Michael Moritz of Sequoia, one of the early investors, he admitted the mistake. He said, "We committed the cardinal sin of retail, which is to expand into a new territory before we had demonstrated success in the first market." And that's true. I mean, that's how any business like Webvan should operate. Soft launch, test your market, make adjustments based on feedback, tweak, all that good stuff before launching into a second market. And then you can speed up as you gain more expertise. But then you have another take on it from David Byrne of Benchmark Capital, who was also an early investor. As he pointed out, it's easy to say we should have opened in a few less markets, but we had a catch-22. We had a unique opportunity to raise a lot of capital and build a business faster than Sam Walton rolled out Walmart. But in order to raise the money, we had to promise investors rapid growth. And I'm coming down on the side of that opinion. I mean, it's the wrong strategy, yes, 100%. The logical right thing to do would be, as I said, to test it in a smaller market, see what worked, tweak, blah, blah, blah. But that completely ignores what was happening at that time. The feeding frenzy that was the dot-com boom. This is why I love the Webvan story, because it taps right into my experience of that time. Reading Fortune magazine and hearing about companies founded by college kids raising tens of millions for businesses, some of which were really good, a lot of them weren't. I mean, that's what inspired me and my friends to just go for it, to come up with an idea, to raise money and believe, for a few short years that we were going to change the world. And yeah, while we were proven wrong, the experience was very real and I loved it. It lit a fire in me, and I'm guessing in lots of other people, that has stayed with me. This love of business, this optimism, this belief that if you have a good idea, then go for it. Of course, there were a lot of lessons learned as well. We made so many stupid mistakes and assumptions. We were so caught up in how we were going to change the world that we just disregarded common business sense. In short, you could say, we lost the run of ourselves. But that's why I think the Webvan story is such a great business story. I hope you've enjoyed as much as I have, and remember, if you have any comments, any corrections, or any story that you'd like us to cover, email us at info@gbspod.com. All the best, folks.